Fantastic. Good morning, everybody. I'm Sean Powell. I want to welcome you to our December 9th, 2010 FXDD co-production with FX Street. Today is going to be a great Forex training. Hopefully you all enjoy it. Our disclaimer is we do not give buy, sell, or hold recommendations. Trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Today's class, this is going to be a great one with Greg Michalowski. It's called My Most Valuable Trading and Non-Trading Lessons. This is exciting. I heard Greg practicing this one, and I think you're all going to enjoy it. Okay, so here's Greg Michalowski. He is on the right-hand side of your screen. He's our Chief Currency Analyst at the company. He's also our FXDD Vice President. You can get him on Twitter, twitter.com/GregMikeFX. I'm on the other side. I'm Sean Powell, one of FXDD's national trainers. I'll be along for the ride, helping out in the chat window. And don't be shy. Make sure you put your Forex questions in there for Greg, and we'll answer those throughout the show and then probably have a few minutes afterwards. All right, so a couple things going on at FXDD, really exciting. Our team that we sponsor, the Red Bull team, won the World Championship and the Drivers' Championship. Congratulations to them. That is just fantastic, and I know everyone over in Europe are big F1 fans, as am I. We've got a new contest starting December 13th. That's next Monday. That is going to be our Demo Dollars contest. Just want to let you know about that. It's going to be coming. Can't say much more about that, but it's going to be exciting. You also have the opportunity to open an account with FXDD. It's very easy. We've got you a landing page set up. It's fxdd.com/FXStreet. Give you all the details there on if you want to open an account with us and give us a try. Okay, so I'm going to get ready to bring Greg on. If you want more information on Greg, I will give you his blog address on FX Street. It's blogs.fxstreet.com/FXTrader-link. As you know, Greg.
All right. I assume everyone can hear me. Thank you very much, Sean, and thank you to the people at FX Street for making this possible. These days are important for me. They're also important for you out there, and the fact that we have a nice audience here today suggests that that there are people out there around the world who are fans of FX Street and like to take advantage of these types of days that maybe you want to think about joining up to their service on a daily basis. Ed Ponzi just finished up his daily chat, and he's one of my favorites, and that's the type of information and education you get from people who participate, and I'm very proud to be part of that. But anyway, my lesson today here, and I tend to give trading lessons to traders out there, and hope that you find that my 25 years of experience in the foreign exchange market are able to maybe give you a little bit of a shortcut as far as what is important, what is not important. But today I'm going to go through what are my top non-trading and trading lessons that I've learned over the last 25 years in my involvement as a trader at major institutions, and over the last 10 years being involved with FXDD. And I break them off into two different sections. One is non-trading lessons, and these are just overall kind of foundation lessons that all traders should have. And oftentimes a lot of traders will ignore these non-trading lessons. They get right to the fact that they want to look at the charts, they want to buy and sell off of certain things. Maybe they pay attention to fundamentals and do trades off of that news, and they ignore what is the fundamentals or the non-trading lessons that all traders must lose. So these are just as important as the trading lessons, and I'm going to be going through what I have as my top 10 non-trading lessons that I've learned over my last 25 years. And the first one is, it sounds simple, but oftentimes these non-trading lessons seem very logical, but I can tell you from my experience, 10 years at FXDD, a retail brokerage outfit, that a lot of retail traders ignore these. They ignore the non-trading lessons, and they don't think of these logical steps that you need to take. But the first thing is, trading is a business, and you have to treat it like a business. If you were opening up any restaurant or whatever, you'd analyze the risk. You'd get all your ducks in the water as far as what you need to not only the food on the menu, but who's going to cook it, what kind of service you're going to have, what are the place settings going to look like, where is my location going to be. All these things go into analyzing your business as a restaurateur, and you have to do the same thing in trading. You have to know your software. You have to know what you need to what tools you need. You need to know a lot of different things, but you need to do things like define your risk, because all businesses define the risk, and a lot of traders refuse or don't think about risk as much, especially when they're getting started. So trading is a business. It isn't playtime. It isn't gambling. This is real live money. This is what you should, and you should treat it as such. You should treat it as a business. The second top 10 lesson that I've learned throughout my years is that trading is indeed not easy. This isn't as easy as programming something and letting it run. I've seen these program systems come and go. There's always a flaw that causes a big, huge loss, and it's those big, huge losses, folks, that will cause your account balance to go from positive to negative. You have to avoid the big losses. So that's and the other thing about trading is that there's no 2 days that alike. Yes, there are similarities. There are things that you can find in the market that make sense, and it's finding those things in the market that are going to move you to the next step as a successful trader. But it's not easy. It's not an easy thing to do. You have to control. You have to not only understand a lot about trading and what goes into being a successful trader, but you also have to be able to control your mind, be able to control your fear. And the thing about it, though, it is not impossible either. There are traders who make money, but you have to work at it. You have to treat it like a business. And so number 1 and 2 kind of go hand in hand. The third thing lesson that I learned, non-trading lesson, is that it's always best to be prepared. Always best to be prepared. If you are prepared before the trade happens or your trade setup happens, you are much better off. And I'm going to go to a chart. I'm going to turn the camera off here for a second and then go up to a chart to show you what I mean by that. And if you take a look at something, anything like the euro versus U.S. dollar here, this is on a daily basis, and this line right here represents a 100-day moving average here. And what I mean by being prepared, folks, is that when the market is in this downtrend, this is euro on a daily chart. I look at hourly and 5-minute charts, and I can find the same type of clues from them as well. But when you look at this, the market coming down to this 100-bar moving average, we do find support against 100. This would be the 100-day moving average, and it's a simple moving average. And being prepared to know where that level is may give you an opportunity to buy the market on a short intraday basis and have the market move a little bit to the upside. But it also allows you to be prepared when the market breaks through that 100-day moving average to take advantage of this more meaningful move to the downside that moved from a level of 133 all the way down to 129.700. In the process, we also went through this trend line. I'll zoom in here. But this trend line, just another simple technical tool that you can use when the market went through that trend line. It also moved, it confirmed the move to the downside and moved sharply to the downside. So being aware of that is important. The same thing happened on this day right here. The market on an intraday basis was trading above the 100-day moving average. And note that the trend line that we were looking at and the 100-day moving average all came in at the same point. So that also prepared you for a move to the downside. So if you are prepared to trade, you are much able to take advantage of these types of moves. So I learned early in my career that I had to be more prepared. I couldn't just come in and say, oh, well, the market is currently trading at 131.87. I have to understand that, oh, there's resistance up here and there's support down here. Or I go to the hourly chart and say, if the market breaks I know that today, coming into today, and I talked about it in my evening report last night, that if we get up to the underside of this trend line, which we broke yesterday and moved back up toward it here today, that would be a resistance level. And why is this a resistance level? Because you can define risk at that level. So being prepared, defining levels right here, having the price move back through the 100-bar moving average, move to the 200, now moving back through the 200 and testing our support here. I'm prepared. I'm prepared for the moves that may happen, and as a result of that, I'm much more profitable in my trading. And so being prepared is a key prerequisite for being successful as a trader. And I'm going to turn the camera off once again and get back to my PowerPoint slides. And I'll turn the camera back on and move over. So number 3 is being prepared. That was another key lesson that I learned. Number 4 in my non-trading lessons is that bad traders can be lucky, but good traders make their own luck. Bad traders can be lucky, but good traders make their own luck. And what I mean by that is that if you are a type of trader who feels like it's necessary to have a position on during the non-farm payroll number, which is what I consider a black or red bet on the roulette wheel, that is, and the market goes your way, I consider that just a lucky trade. I mean, you were just lucky. There's 300 million people in the United States, and you're trying to make a bet off of plus or minus 50 or 100,000 difference than the number. You don't know any better than any of the economists who are making the estimate as far as what that non-farm payroll number may be. And so when you have a gain like that, it is pure luck. I hate to say it, but it's pure luck, especially if you put the position on right before the economic release. The reason why that is dangerous is that if you are right in that trade and the market, the number comes out in your favor and the market moves in your favor and you book a profit, the problem with that is that the next time that number comes around, you're going to think that you're going to have the same crystal ball in front of you that's going to tell you what the number is going to be, what the change in non-farm payroll of 300 million people in the United States is going to be. And if you're wrong at that time, that is going to mess with your mind, folks, because you're right once and you're wrong once, so now you don't know what to do. And you're going to increase your fear, and fear is the trader's worst enemy. So what you have to do, folks, is be more smart with your trading and not trade during those more risky times. And that defines a good trader, a trader who evaluates risk, who realizes when the trades are lucky and when you're putting more of the odds of success in your favor. Without going back to the previous chart, but when we're looking at that underside of that trend line this morning when I was talking about being prepared, visualize it in your mind, folks. But that is a good trader. A good trader will sell against that level or sell when the market goes below the 100-hour moving average or a key technical level. And the reason why they're a good trader is because they define their risk. They are able to define the risk. They know where the risk is. There's no external risk like event risk that may cause like a non-farm payroll number that increases your risk, that increases the luckiness of the trade. But by defining your risk, you are creating your own luck. And by that I mean that someone who's not familiar with trading will say, oh, he was just lucky. He sold near the highs there. No, he sold near the highs for a reason. He sold against the trend line. And if you sell with a reason against the trend line through a moving average line, things like that, you create your own luck when it goes your favor. When it doesn't go your favor, you lose a little. When it goes your favor, you have the potential to gain a lot. So good traders make their own luck by defining risk and trading at key levels that the market can define risk. Everyone could see that trend line. That defines the risk for you. If it doesn't work for you, you get out of the trade. So that's a key lesson that I learned, a non-trading lesson that I learned through my 25 years. Number 5 lesson that I learned was that I realized that if I love trading, I can go further. If you love something, if you're passionate about something, if you're passionate about your wife, you're going to have a better marriage. If you're passionate about accounting like my wife does, which I can't understand, you're going to be better at your job. If I'm passionate about trading, if you're passionate about trading, you're going to go further as well. You're going to start to learn how to trade. You're going to start to learn how to be prepared. You're going to realize that it's not easy. You're going to realize it's a business, and you're going to realize that you have to make your own luck, not rely on luck to win. And if you do that, if you love what you're doing, if you love trading, you're going to go much further. Number 6, learn. FX Street has these seminars or webinars every single day. And if you're a member of their program, or if you come to these free access days and you learn, you're here for a reason, to learn. But what you have to do is weed out the bad from the good. Not everything is going to be to your liking, and there are certain tools that you can use, and we'll go through a little bit later, that will not necessarily do you any good. So you have to. Not everything is great in the world of trading. Not every tool is, I think, a tool that's going to be beneficial to your trading. So what you have to do is learn. Take the learning level up to a point, but then start to weed out the bad and understand why you're weeding out the bad from the good, and keep it a little bit more simple. Number 7 is that you need to build your foundation first. If you haven't built your foundation, go back and do it. And I know if you have a good foundation, if I could ask you what your mission statement is trading, and you have one. I know you have a good foundation if I can ask you what your game plan is going to be to get to that mission, or to satisfy your mission statement. And if you have a game plan to satisfy your mission statement, then I know you've built the foundation. I know you've built the foundation if you know the rules that you're going to apply to your trading, because you need rules that are going to discipline you to allow you to become a good trader. Then I know you're a good trader. If you do these things that I call the foundation, these non-trading things, then you are on your way to becoming a better trader. And I had to do that first. I was very enamored by the fact that, I'm going to buy low and sell high. That doesn't always work, folks. It's working a little bit in the last few days, although we're breaking to the downside here in the euro now. But what you have to realize is that the trending markets are where the most money is made and lost. And if you buy low and sell high in a trending market, you're going to get the wrong way. You're going to trade against the trend. So you have to build your foundation first and understand what you're trying to do and why you're trying to do it, and not just go buy low, sell high type strategy. You have to have more than that. You need to build your foundation. The next thing is you need to learn to accept failure quickly. And I'll go back to my wife, who's an accountant, and maybe I'll talk to people who may be lawyers out there, or doctors, or maybe you're retired and you're an engineer. Those types of professions, you cannot be wrong. You cannot have the stress on a bridge be wrong because the bridge may fall down. You have to build things to specifications, to codes, or else the building may, not be as strong. The house may not be as strong. And when the next big gust comes along, it may just fall down, So you have to be right in what you do. And so those types of people who are traders, oftentimes they can't relate to to be a trader. Why? Because it's about failing in trading. You can be right 50% of the time and wrong 50% of the time, or even you can be right 40% of the time, wrong 60% of the time, and still be an excellent trader. So you have to be able to accept failure quickly. And those people who can't accept failure quickly, and what I've learned was that if I couldn't accept failure quickly, or I wasn't quick enough to accept failure, I let my losses ride. And I also covered my gains too quickly. So you have to accept failure quickly, understand why you're getting into a trade, define that risk, and then get out of the trade quickly, even if it's at a loss, because traders lose a lot. If you're right 40% of the time, wrong 60% of the time, you can still make a lot of money trading. It's a matter of letting those wins move in your favor and cutting your losses real quickly. Number 9, blame. If you're wrong in the trading, and this is about failing, if you're wrong in the trading, don't blame yourself. Blame the market. If you have a reason to do a trade, like trading against the trend line, trading against a moving average line, then you are saying to the market, I think to the market. Notice I say the market. You are saying to the market, I think that you and the rest of the market are looking at the same thing I'm looking at. You're looking at this trend line. You're saying that the market should stop at this trend, or I'm saying that the market should stop at this trend line, and I'm hoping that you're looking at the same thing I am, and that the market is going to have trouble here. If it doesn't, I'm going to get out. If the market, in our example that we looked at earlier, broke above that trend line, you would get out. Don't blame yourself. Blame the market. The market wasn't thinking like you were. It's not your fault. You did the trade for a reason. Just accept that loss and get out. So blame the market. Don't blame yourself. It's an important piece in order to stay positive about your trading. Also, never blame your broker. Being a broker, it's not our fault that you did the trade. We just provide the liquidity that allows you to trade. So blame the market, but don't blame yourself. Don't blame the broker either. Manage your money and manage your losses. We've talked a lot about that already. Money management is so important in trading. If you lose 10% on, or if you have 50 trades and 1 out of 10, you lose 10% in that trade. You're not going to be successful as a trader. You have to manage your money. Risking 1 to 3% per trade is what most successful traders do. I've added 2 more here about non-trading lessons that I've learned. And the first one is it's all about risk, folks. It's all about risk. If you're opening this goes back to number 1. If you're opening up a business, you are concerned about your risk. What is the risk? What is the minimum amount of people that I'm going to have to serve tonight in my restaurant? That is my risk. Now I got to figure out how I'm going to get those people in, why they're going to be attracted to my business, and I want to know that risk. And if I don't know that risk, then I don't have any business in being in the restaurant business. I should just stop it right there. In trading, you need to know your risk. If you don't know your risk, you don't know where to get out. You don't know when you're wrong. And remember, number 8, you have to learn to accept failure quickly. So all this kind of moves back to the idea of risk. And the final one, which is actually the top 12, is save the fundamental stories for the dinner party. And what I mean by this is too many people try to trade off fundamental news. And fundamental news can be ambiguous at times, but it's what makes us sound smart. But oftentimes, the things that make us sound smart, the euro is going to go down to parity. The euro is going to go up to 150, or the dollar is going to get hit to, and the euro is going to go up to 155. All those stories that you hear, the fundamental stories, are good for the cocktail parties, good for the dinner parties, but they don't define your risk, and you need to define your risk in trading. So those are my top 12 reasons, non-trading lessons, in a nutshell here. I can go on and on about each of them and probably do a lesson on each one of those in one of these webinars. But I just wanted to get the broad overview of these non-trading lessons that you must follow in order to be successful. So now I'm going to go into my top 10 trading lessons that I've learned throughout the years. And the first one is that there are different types of trading days. Knowing what type of day is important. And this goes back to the roots of my trading when I started to learn about what was called the market profile. And really quickly, this chart may not seem very familiar to a lot of you people, but I'll explain it really quickly. And what the developer of the market profile said is that he would segregate each day into half-hour time segments, and he would letter each half-hour time segment with letter A, B, C, D, E. So in the first half hour of trading, and this happens to be the bond futures contract, I used to trade that way back when, and it kind of taught me an important lesson. But in the A period of the first half hour of trading, the market traded between 101.20 and 101.26, and that was marked by the letter A. And then the B period, the second half hour, we had a high of 101.25, and so you add that letter here, and you continue down, and the market went down to a letter to 101.16 in the B period, and the C period had a high of 22, and it rotated all the way down to a low of 11. So you can see here that over time, the market developed the different types of patterns as the day progressed, and this pattern is taught me, or is a common pattern within the market profile in any trading market, is that you have extremes. at the upper end and the lower end, and then you have a high volume price, and this looks like a normal curve, a normal distribution curve. And what it taught me, folks, was the sell high, buy low type strategy. You have in the development of any type of day, you tend to have a high volume area where most of the volume takes place, and then you have these extremes around that high volume area. So that was one type of day, and this taught me how to buy low and sell high, or the importance of buying low and selling high. Now, I already mentioned that doesn't necessarily get you to becoming a good trader, because in a trending market, you tend to get in trouble. The next type of day, I'll get to that in a second. The next type of day that developed was what is called a non-trending day. And this looks very similar to the previous example, except the range is very narrow here. Only 7 or 8 prices were traded during the day. A very narrow trading range, very low trading day, and it typically involves low volume in the narrow range. And what I learned was that non-trending days, or what the different types of days said, was that non-trending days often preclude, or often are a prerequisite or a prelude to what is called a trending day. And in this type of day, you have a different type of formation here. We don't have that normal distribution that forms in a normal trading day. What you have is A period starts, B period, and then C marches higher, and D and E and F, and you can see this progression to the upside. So non-trending days tended to lead to trending type days, and trending days left like clues, like these open areas here where we had what we call single prints. And so I started to learn about these types of trading days, and the most important thing was that the non-trending days I found transitioned into trending days, and that was important to me. Why? Because if you had a non-trending type market, you could anticipate a trending type market, and then all you had to do was follow the pattern of the day, see the clues that it gave in that non-trending type day pattern, and that allowed you to get in at decent levels. And the importance of that, folks, is that most money is made and lost in trending markets. Trends are directional. Trends are fast. If you trade against the trend, you have a good chance of losing a lot of money in a short period of time. If you trade with the trend, you have a good chance of making a lot of money in a short period of time. It's just a matter of staying on the trend. So if you can anticipate a trend from a non-trending type day, I learned that could often be a clue to that a trending day was on the way. And so this was an important lesson that I learned early in my career, and it's I use it to this day. Even to this day, I'm always looking for non-trending type days that transition into trending type days. And so what I often do to kind of understand that more in the market is by taking a look at what is the average range for something like the euro versus US dollar. In this case, I've taken the high and low price on each day, and I've figured out a 20-day average over of the high-low trading range. So let's say today's trading range is 100 pips, and tomorrow's trading range is 110 pips from the high to low, and I want to figure out a 2-day average. It would be 105 pips. So I did that for 20 days, and this is the graph going all the way back to 2000 of what the average range is for the euro versus US dollar. And so in this recent time here, going back to 2009, so like September, what most of the pattern has been with the range at a low of about 110 or 120 pips for the euro versus US dollar, and the high range has been about 150. So what does that say to you? Let's discount these moves to the upside here. What does that say to you? And I'm going to turn off the screen here again and go to some of my charts here. And so what does this say? And what this says to me, I'm going to go this period right here, is that if you look at this chart right here of the euro versus US dollar, and you can see that over this period right here, and this is a 5-minute chart, you can apply the same logic to a daily chart or any type of period. If you know what, like for instance, if you know the average range for a month, I heard someone say in the previous webinar by Ed Ponce that if the average range, looks like the euros might be in a 250 pip trading range for the month, that would be the most narrow trading range in the euro going back to at least 2007 for a month's time period. And so it's not likely that would happen, that we were probably going to have a more than a 250 pip trading range. But let's go. We know from that previous chart that the average range is about 120 to 150 pips. But if we know that by looking at the chart here over this time period, and this may start at, let's see, this is 1800 hours, so it's 6 hours to 0, that's 5 o'clock, and then it's another 11 hours. So we're talking about 17-hour time period here where the market stayed within a range of 132.46 down to 131.86 or so. So that's 14 plus 46, that's a 60 pip trading range. Folks, if you know that the range is 60 pips and the average range is 120 pips, i.e. this is non-trending, you know that may transition into a trending type of move, or at least an extension of the range that would get it to a more normal distribution. There's no guarantee, but there's a pretty good shot that the 60 pip trading range is going to be extended. So when you start to see these types of ranges, or these types of non-trending type days, or non-trending periods in any currency pair, if you know what the potential is, you have a better chance to take advantage of a trend type move. So in this case, you could have bought against this support down. I'm going to zoom in here a little bit. You could have bought down against the support trend line here that's connecting these lows right here. You could have bought on a move above the 100-bar moving average and the 200-bar moving average. That's these two moving averages here. And then this is looking at the 5-minute chart. You could have bought there, and you would have had good trade location. Your risk on this trade, a move below this low here. It comes in about 10, 15 pips or so of risk if the market should move below that level. You're out. Why? Because the market isn't doing what it should do. If your gain, your potential gain, who knows what the potential gain is, but what you do know is that you have good trade location. You can define your risk, and if you can define your risk, you can luck your way into a potential strong move to the top side. And this is what non-trending to trending means, folks. A non-trending leads to a trend, either to the upside or to the downside, and you don't know which way it's going to go. Admittedly, it goes our favor, it goes to the upside here, but what you do know is that you can define your risk. You can look at the market very closely, and you figure out that, okay, I'm going to buy at this area right here. My risk is a half of box in this grid formation here. If the market goes down below this line right here, I'm out. So that is my risk. My potential gain is, well, at least taking out the highs and possibly going 60 pips above the old high at the 45 level. That would take us to what, 133, and it goes up to 133 in this chart. If we go another 60 pips, I'll put a line in here to give you an idea. 133 is only to that point right here. So you're risking this much to make that much on a normal type trade, and that is a good risk reward trade, and the importance of non-trending transitions into trending. I hope everyone sees that, but it's one of the more, it's a foundation, I think, for all successful traders, is understanding when the potential exists for a possible trend type move. So let's get to my next rule for trading, and that is that if in the previous I said fundamentals are good for cocktail parties, what is good, one of the trading lessons was technicals, that is charts rule, because they define risk. and fundamentals become a secondary tool in your trading. I'm not saying get rid of all fundamentals. Fundamentals are important to develop a bias, but what you have to realize, folks, is that the technical tools that you use in your trading are going to define your risk, and if they define your risk, you're able to understand where you are wrong in your trade, and if you can define that risk, if you know that the risk is that one box in our previous example, then you on the grid, then you know that that where your risk is and what you're willing to lose, and if you can accept that loss, you are on your way to the potential of getting lucky on the trade and having the market move in your favor. So technicals are key, and they should be the primary tool that all traders use in order to be successful. Number 4 of my top 10 trading lessons is actually off of a quote that one of my colleagues at FXDD says often, and he doesn't necessarily talk about trading. He's talking about life in general, but his comment is this: life is simple, people choose to make it complicated. Life is simple, people choose to make it complicated. And I learned earlier in my career that that quote can be switched around to something that says trading is simple, people choose to make it complicated. But what I mean by that is that oftentimes I will look at a retail trader's charts, and they'll have so many things on that chart that you can't understand where the risk is. They may have 4 moving averages, they may have Bollinger Bands, they may have RSIs, they may have MACDs, they may have stochastics, they may have CCIs, all on the same chart, and they're trying to figure out what to do. And oftentimes those tools that they use contradict each other. One's bullish, one's bearish. And so imagine what that does to your brain as a trader. Yeah, people think that is better. More is better. The fact is that trading can be simple. You don't need all those tools. You need I use three tools. That's it in my analysis. I could use more, but I can get all that I want out of my charts that determine bullish or bearish bias by looking at 3 simple tools. And it wasn't until I figured this out that I started to become more successful trader. So that's one of my other lessons: is don't complicate your charting, your technicals, with having too many of them. Number 5 is that the market does not care about esoteric trading systems. What I figured out is that I should care about what the market is saying, what the market is thinking. And what I mean by this, and I've gone through this, and I'm sure there are people out there who do the same thing, is that I early in my career thought that it would be a good idea for me to try to beat the market by figuring out some sort of oscillator, some sort of some sort of system that took a bunch of different technical indicators, put them all into one, figured out a oscillator or an index for those different trading tools that would give me an overbought or oversold situation, and I would trade off of that. What I soon realized, however, was that I was the only person in the world looking at that esoteric trading system, that esoteric index, that personally defined index. And by doing that, I was telling the market what I thought the market was going to do. And that's the total opposite of what you should be doing. Instead, what you should be doing is trying to look at those things that the market is looking at. Look at those things like that trend line, like that moving average line. Look at those clues like that non-trending period, like that 60-pip trading range that has the potential to extend to 120 pips. Those are what you should care about, not what you think. I like to say that the market does not care what you think. The market is going to do what it thinks. And if you think that you can tell the market that it should be bullish now, and darn it, because that's what your system says, think again. That may work every once in a while, but it's going to get you in more trouble than it is going to help you. So instead, try to shift your focus back to what the market is looking at, what the market is thinking. The other thing is, or the number 6 my top trading lessons was that most money is made and lost in trending markets. I've already addressed this a little bit by saying that my most famous quote, or not my most famous quote, that trends are directional, trends are fast. Traders lose the most money in trending markets. They also have the potential to make the most money in trending markets. At FXDD, what we typically see is that in a trending market, most retail traders will try to trade against the trend at some point or another, and then the market will continue to trend and trend and trend and trend, and that is an error, and that's where most money is lost, by trading against the trend. So what you have to always do, and what I always focus on, is try to trade with the trend. If the market is non-trending like it has been over the last few days, you stay out of the market war, or you look to trade near levels that are most that are sort of risk. I'm not saying risk-free, but will give you a clear bias one way or the other. For instance, sometimes even trading in the middle of the trading range over the last 2 days is a good way to take advantage of this non-trending market that's eventually going to turn into a trending market. What you need to figure out is where it's going to break and look for those targets down the road. Number 7, certain technical tools can be effective at the wrong time. Certain technical tools can be ineffective at the wrong time. And I'll go back to my charts to show you what I mean by this. I'm going to put up a chart here, and I know Ed Ponce looked at the RSI indicator in his last session, and some of you may have seen that. But what I mean by this is that when things like the RSI indicator, and this is a tool that a lot of technical traders will look at, what the RSI will fluctuate around is the trading range. And so if you have a period like this period right here, defined where the market was going up and down in a narrow trading range, this trading range over this month period was very narrow, it was around 345 pips. That's a very narrow trading range for a month's time period. You can go even back further. This range is very narrow, and what that will do to the RSI is it'll cause it to become a little bit more reactionary to the narrow trading range. And what do we know about non-trending periods, folks? Non-trending periods will transition into trending periods. And so what will happen is that when you get to these points where the market starts to trend, you will get an overbought situation that will say the market is overbought at this point right here. The RSI is at a level of around 78 here, and the market is overbought at this level. Sell the market. So you sell, and you see the RSI go down. What does the market do? It goes down by about 20 pips or so. Is that enough for you to take profit at this point? Probably not. You get on the wrong side, the market starts to trend higher. It goes back above the 70 RSI right here. You're thinking, oh, the market's going to correct again. It does, but only by a very small amount, and it trends higher. It gets overbought at this point right here. You're looking for that correction. It doesn't. It goes higher, and you end up trading against the trend. This is a tool, the RSI, that can be very, very dangerous for your trading. If you have the RSI as your number one trading tool, I suggest that you don't trade it. Why? Because trending markets, you make the most money and you lose the most money. You have to get away from that RSI indicator. There are other ways that you can look at the market without and figure out an overbought or oversold situation without using the RSI. So that's what I mean by the fact that there are certain tools that are very ineffective, and the RSI is certainly one of those tools. So let me go back to my thing. So number 8, I believe that 3 tools are better than 1. If you there's traders out there that go the opposite, where they'll just have a certain indicator on a moving average, and they'll trade that moving average. I think that you have to use a combination of tools. I use 3. I use moving averages, I use trend lines, I use Fibonacci retracement levels, and by using those 3 tools, I'm able to not only get entry levels, but I'm also able to find targets down the road, targets that will tell me that the bias or the trade to the downside, for instance, is continuing as per expected. And what good traders do is not only do they have entry levels, but they also have targets along the way, and those targets come from the tools that you use. So I find that the 3 tools work just fine. I use trend lines, I use moving average lines, and I use Fibonacci retracements. I also use 3 different types of charts. I'll use the 5-minute, I'll use the hourly, and I'll use the daily chart. And by using 3 different charts, I also find targets down the road that will allow me to trade more effectively. I'll get to that in just a little bit. I can show you some examples of how I use 3 different charts. I just want to get through these top 10, and then we can get to some questions if you have any. And finally, I think that although I use 3 tools and I use 3 different charts in analyzing the market, I think that if you use too many charts, it's worse. It can be worse for you as well. So, for instance, I often see traders who will have a 1-minute chart up, a 5-minute chart up, an hour chart, a 4-hour chart, a daily chart, and what they'll do is that too many charts will cause too much confusion, cause too many. It can be ambiguous. You can have contrary. One chart is saying bullish, one chart is saying bearish. So I found that 3 tools and 3 charts is the perfect mix. It's the porridge is just right. It's at the right temperature. The seed is just right, and the bed is just right for the 3 little bears and in the 3 little bear nursery rhyme. That is what works for me, and I suggest that maybe you start to look at it that way. So those are my top 10 non-trading and trading lessons that I've learned over my career. There's a lot that goes into it. If there are people out there who would like this the list via the PowerPoint presentation, you can just send me an email at greg@fxdd.com. If there are any questions, I'll be happy to field your questions. And I can also possibly look at the 3 different charts if you'd like 5-minute, hourly, and daily, and try to show you how they dovetail each other and how I look at them. So any questions here, shoot them into the session. Thank you all for coming out here today. We got about 10 minutes of question time, so put your questions in, and we'll go from there. Or if you want to look at any currency pairs, I'll be happy to take a look at any sort of currency pairs for you. Take a look at them all.
Hi, Greg. You may want to answer the question from Jez about being impatient when trading.
Okay, and
how to solve that.
All right. One would have less trades for a setup to get. How does one control the impatience of not being in a trade? That's a good question, and I think that what you have to do, what traders often do, and maybe this is a lesson that I've learned, is that you do have to be patient with your trading levels, and if you are impatient, if you take too many signals, if you're too quick on the trigger, at times you can find yourself that you get out of sync with the markets, and this may go back to this idea of using 3 different types of charts in my analysis. Let me get this on here. There we go. What I often do, Jez, is I will look at the different charts and see what they are telling me, and try to be a little bit more patient in my understanding of what I'm trying to do. So, for instance, I talked about this hourly chart here, and you can see how the lines are defined, or the trend line is defined here. 1, 2, and then the market on yesterday comes down to that trend line, finds some support against that line. We're also against this 100-bar moving average and against this low here. Now the market moves below that and trends to the downside yesterday. And then I'll always keep that trend line in there, and some technicians don't pay attention to it. But I will find that a lot of times the market will use that underside of that trend line as a resistance point. Obviously, this was a pretty good move to the downside, and they'll use that level as a resistance point, as a borderline level. Now, what you can see here, if you just looked at this hourly chart, is that we're above the 100-hour moving average, so that should be bullish, and that's what we saw here, was this move to the upside here. And let's say you don't have a position and you're more bearish on the euro. You think that the Irish situation, everything else is, so you have a bearish bias, but you're seeing the market act more bullishly here. But you let the market go through the 100 and come up to this 200 or this underside of this trend line. You may still not do the trade at this point right here. You may look for clues from the other charts like the 5-minute chart. And in this case, because obviously the move to the upside is pretty strong here, so you're a little bit hesitant about what to do. So you want to be a little bit more patient, or you start to think that, well, maybe I should be a little bit more patient. So what you can do is take a look at, let's say, the 5-minute chart and see this and see how it's using the 100-bar moving average as support right here. But then it breaks the level at this point right here. This is at 132.99 or 133 level. And this gives you the confidence to execute the trade, gives you more confidence in your trading. So if you find yourself that you're impatient in your trading, what I suggest is A, recognize that you're impatient in your trading, and B, become more patient in your trading by looking at the possibility of using two different reasons to trade. In this case, the other thing that of significance here about the 133 level is that the 100-hour moving average is right at that level as well. As you can see, it's at 94, and this 100-bar moving average gets broken at 99 at this point right here. So this gives you a couple of reasons within 4 pips of where your risk is, defining your risk, and then you're able to take advantage of it. So the best advice that I can give for people who are impatient is to try to be more patient by looking for multiple reasons why a trade should be executed. And if you do that, you can take advantage of these sharp moves. This is all as a result of both this and this breaking the 100, and the fact that we couldn't get above that underside of that trend line. Any more? Go for a look. Once you identify the trend for the session on a daily chart, is it okay to then trade lower time frames the rest of the session, or must you keep watching the daily? That's a good question. It gets to here's the way I look at the 3 different charts, and this will probably take me to the conclusion here today. But what I will look at, folks, is if I look at the daily chart, I want to see what's in play. Now, I've already told you that I look at 3 different indicators. I'll look at the Fibonacci, so I have a Fibonacci going from the low to the high, also a Fibonacci going from the high to the low on this corrective move to the upside. The next thing I'll look at is a trend line right here, and the next thing I'll look at is a moving average line, the 100 and the 200. So coming into today, and this is another reason why there may have been resistance at the top here, is I'll take a look at the daily chart and say, oh, look, the 100-day moving average is at 133.44. The high for the day came at 133.22. So I know there's resistance on the daily chart. I know the bias may be that there's going to be sellers. I know where my risk is. If the market goes above the 44 level, I know that's going to be risky. So if the market is near a trend line, near a moving average line, near a Fibonacci retracement, and you can see all 3 are together here. We have the 100, we have the trend line, we have the 38.2% retracement. All of them are very close together, so this becomes a good point on the daily chart. If the daily chart and the price is in play, then I pay attention to it, and it becomes a key level. Why? Because the 100-day moving average is going to be a key level for the euro. Whether it acts that way or not, it's still going to be a key barometer for the euro. So then I'll start to go and look down at my other charts, and I'll put in the reason why I have this 41 level in the chart here on the hourly chart, really should be 42 or 43 right at that point right there, is because that is the 100-day moving average. So I know that is a resistance level on the top side. And then I'll look at the other charts, and I know, okay, well, this is a key level on the top side. I know this is going to be a key level on, for a line. And then I'll wait to see, okay, well, what is this telling me? This is saying my risk, if I sold here, what is my risk? The risk is if it goes above 43. Would you risk 24 pips on a trade? Most people do. You know, could that be less than 2% of your account? Yes, you can adjust it to be, 2 or 3% of your account. So you can do that type of trade, and if you do that, against this level, you have the potential to have luck go in your favor in the market to move your way. So you start to drill down and try to figure out, what are these three charts telling me, and do I have a trading opportunity on each of them, or two of them, or three of them? And if you do, you're much better suited to profit from that trade. So that takes us to 10:59. I think there's another session coming up after this. If you want to ask me any other questions, you can send me an email at greg@fxdd.com. The maximum percentage I would risk on any one trade is 1 to 3%. More than 3% is getting into more risky areas. 5% is a little bit too much. So I really appreciate everyone coming in here today. Again, if you need a presentation, send me an email at greg@fxdd.com. Thanks to the people at FX Street for making this all possible. Without them, this market would not be as robust as it is, and I really appreciate what they do. Thanks again, everybody. I really appreciate it.